Hi, and welcome to Business Advisory and Tax Tips. I'm your host, Michelle Burke, coming to you live from Annapolis, Maryland. Many of you know after 30 years in the corporate tax world, I went out on my own last year and created health and taxes. There are only two things certain in the world, death and taxes. I'm here to help you flip that to health and less taxes. Today, I'm going to update you on what's going on with the Biden tax policy, how that will impact your small business and you personally. I want to talk about 4 different areas of tax. 1, corporate, individual, capital gains, and net wealth taxes. First, to kind of set the stage, during his campaign for presidency, Biden promised not to raise taxes on household incomes less than $400,000. Many are stating or hearing in the news that Biden promised to reverse a 2017 Tax Cut and Jobs Act, where millions of Americans and corporations, businesses, had reduced tax impact from that. So it'd be a contradiction, or it wouldn't be possible to reverse the 2017 TCJA and make the other promise come true. So recently, the White House press secretary, Jen Psaki, stated that Biden remains committed to his promise to not raise taxes on household incomes less than $400,000, and that he has made other proposals like the child care credits to help support lower income families and middle income families. So that's the latest on that. Why are we talking about taxes today? I think most of us know that there's a $4.1 trillion package called the Build Back Better plan that really consists of 2 legislative proposals. One is the American Jobs Plan for $2.3 trillion, and the other is the Americans Family Plan for $1.2 trillion. And what we hear is that this is going to be paid for through corporate taxes and taxes on wealthy Americans. So that's why we're talking about it. I want to make it very clear what I'm talking about here are proposals. They're not law. Congress is talking about these in many different forms, but you can rest assured $4.1 trillion of additional spending will not be happening unless there's some offsetting tax increases to help pay for these. As you know, in March 2021, we already had the $1.9 trillion American Rescue Plan, and we had 2 stimulus plans, bills that came out in the prior administration. So a lot of government spending. So it is no surprise that we need to find ways to pay for continued government spending. So rest assured that taxes will increase. But I'm here to tell you that those taxes will mostly increase, or the original proposal is that it would be on corporate America and on wealthy Americans. So let's walk through the 4 points that I mentioned. So first is the corporate tax rate. The current corporate tax rate is 21%. Previously, prior to TCJA, it was 35%. The proposal under Biden is to raise that to 28%. There's a lot of speculation that will increase to 25%. But remember, this is all negotiations right now. So expect the corporate rate to increase if these bills get passed, somewhere between 25 and 28%. 2 other things to note on the corporate side are there's a proposal for a minimum tax on book income This is a little bit different than the alternative minimum tax we previously knew. So this is a new minimum tax. So it would start on businesses or corporations that have book income of $100 million or more, and it would be a 15% tax on that income. So kind of like a flat tax. What we don't know, because this is just proposed, there's no details on if there will be any allowed deductions or not. All we know is this is to target the Amazons and the GEs of the world who have book income, but taxable income of zero, so they're not paying U.S. corporate tax. In the second point I wanted to make is that foreign earned income. So if you're a U.S. global company, since TCJA passed in 2017, there has been a foreign earned income. It's complicated, but it's 10.5%. The proposal is to raise that to 21%. Whether that'll make it to 21% or not, again, all depends on negotiations, but I just wanted to know that's out there. So first, the impact on corporations. Second, I want to talk about the impact on individuals. And lots of small businesses are Schedule C, there are partnerships, there are S-corps, and so they're flow-through entities. So those entities aren't paying tax, but it flows through to them if they're holding it as an individual, and then it's subject to the individual tax rates. So I wanted to make you aware of what's going on with individual tax rates, what the proposals are. So first, the current top income is 37%, and that is for single taxpayers on income greater than $523,600 and married taxpayers on $628,300. The new proposal is going back to a top rate of 39.6, which is where it was prior to the 2017 law changes. And there's also talk of limiting itemized deductions further for those top taxpayers as well. So this proposal of the 39.6% would kick in at $400,000 of AGI per household. So again, some current taxpayers at 35% or 37% marginal rates would be impacted by that. And the focus again is on households of 400,000 or greater of income. There are two other things on the individual side. One is child care credits. You're hearing a lot about that. There's three proposals out there currently. The Biden proposal is $3,600 per child under the age of 6 and $3,000 per child between the age of 17 and 6. That would be for 2022 through 2025. There's currently a $2,000 child care credit in place. And there's talk about how to get that money, not at the end of the year when you're filing your taxes, but to send you some of that money during the year, kind of on a monthly payment schedule. So you would be getting the benefit during the year. A second proposal out there by Mitt Romney is very similar. It has $3,000 for dependents or children between the ages of 17 and 6, but $4,200 for children under the age of 6. Josh Hawley also has a proposal out there. His are only for children under the age of 13. He would give, his proposal says that if you're a single taxpayer with a child under 13, regardless of how many children under the age 13, you get a flat $6,000 tax credit. And excuse me. And if you are married and had any number of children under the age of 13, you get a flat $12,000 tax credit. And then the thing that impacts probably self-employed and small businesses the most is the payroll tax increase. So keep in mind, for payroll taxes, the Social Security and the Medicare, but in particular Social Security, both pieces. As a self-employed, you pay both pieces, the employee piece and the employer piece. So Social Security could be 12.4%. That is on all income earned up through the first $142,800. And then you don't pay the Social Security piece anymore. The proposal then is to pick up again. So there would be from 142,000 up to 400,000. There wouldn't be any additional Social Security tax, but once you hit that first dollar of 400,000, each dollar after that would be subject to the Social Security tax again. And so whether you're an employee or self-employed, you would be subject to this. Now that's proposed on household income. And so again, a little complicated how that's going to work. The self-employed and the employee share is usually looking at the individual and doing the tax on that. But that could really impact small businesses that are making more than $400,000 a year. So I just wanted to point that one out because that could be a significant change. The third item I wanted to bring up is the capital gains tax. I think a lot of people are hearing quite a bit about the capital gains tax, so I wanted to point out a few things on that. So just to refresh your memory, if you have a short-term capital gain, so that's you've had an investment, either property or stocks, bonds, any sort of type of investment, and you have a capital gain on it, and you've held it less than 1 year, that's going to be taxed at ordinary rates, which means whatever your tax rate is, that's the same rate that's going to be used on your short-term capital gains. The long-term capital gains have been given favorable treatment. So currently in place are a 0 rate, a 15% rate, and a 20% rate. The 20% rate kicks in on adjusted gross income greater than $441,000. And the 0 is for 40,000 AGI or less. So very favorable capital gains rates that are out there currently. And then I want to mention on top of the 20%, under Obamacare, a net investment tax came in that's 3.8%. So taxpayers with an adjusted income greater than $200,000 are subject to the net investment tax. So that can add another 3.8% to interest, dividends, capital gains, those types of things. So it's a total 23.8% federal tax on capital gains today. What is being proposed is that all capital gains of greater than, so if you're earning more than $1 million, all capital gains would be taxed as ordinary. So if you're earning more than up to $1 million, your capital gains are going to be taxed at 39.6%, assuming that new marginal rate comes in, plus that 3.8%, so that's 43.4%. And then depending on what state, you also have state impacts. So if you're in California, you would be paying 56.7% capital gains rate, and in New York, you would be paying 58.2% capital gains rates. So again, I just want to point out that the starting point is for income earners of $1 million or more. So the everyday person is not going to be impacted by that capital gains rate. This alone is expected to raise over $1 trillion in taxes over the 10 years. Now, many of you will say, well, those people will just hold their appreciated property longer, right? And maybe they will. But I just want to point that out because there's a lot, you see the market changing. There's a couple things going on, but one item affecting some volatility in the market is talk about the capital gains tax going up. I want to point out worldwide, Europe has an average of 19.3 capital gains tax. Denmark has the highest at 42% in Europe, and France and Finland have a 34%. This would be the highest U.S. capital gains tax ever. So again, just depends on what Congress negotiates and where they land on this, but hopefully that helps clarify that a little bit. The fourth item I wanted to talk about is wealth tax. So this is a proposal by Senators Warren and Sanders. They've proposed a wealth tax currently on estates greater than 11.5 million. So you pass away, you have your estate. If it's valued at 11.7 million, it would be subject, anything over that is subject to a 40% tax. Warren and Sanders are proposing that goes back to the 2009 rates, limits, which was 3.5 million of estate. So if your estate is greater than 3.5, then it would be subject to tax. And that would be at a 45% rate. Many of us are also hearing a repeal of stepped up basis. And so I want to explain that for a minute. So often when you inherit property, so that can be investments, that can be real property, anything type of asset that you inherit gets a stepped up basis, meaning at the date of death, the property that you inherit would be valued, and that value on the date of death is the value that you would have for your basis. So for example, if your grandfather bought some stock for $5,000, let's say $5,000, today it's worth $100,000. He passes away today, it would be valued to you at $100,000. Then if you sell it 2 days from now and it's appreciated to $110,000, you would only pay capital gains tax on that additional $10,000 between the $100,000 and the $110,000. So your capital gains would be on that 10. So we say you got a stepped up basis at the time of death. So there's been a lot of talk to repeal that because it's wealth generation passing. You're passing on this wealth, and so there's been a lot of talk about repealing that. What the proposal out there is for the estate to pay tax on unrealized gains on the assets. So what that means is the estate, as we mentioned, it has to look at all of its assets, look at the value of those assets, and then pay tax if it's greater than those thresholds. This is suggesting that regardless of what the thresholds are, the estate would pay tax on the unrealized gains. So the tax would be paid within the estate. So keep in mind, if the estate has cash and assets, it may have enough cash to pay for that estate tax. If it doesn't, it would have to sell off assets in order to be able to pay those taxes before it gives those assets to the individuals that inherited it. Then at that time, you would get a stepped up basis because tax has already been paid on it. You would get the basis at that point in time. So a lot going on with that proposal, and I think that's a pretty interesting proposal, and I think you'll hear a lot more on that. So those are my 4 things talking about individuals, corporations, capital gains, and wealth taxes. And so kind of to summarize it, really, if you're earning more than $400,000 in your household, that you can expect to pay more taxes. If you're a corporation, you can expect to pay more in taxes. But the initial negotiating point is if you're less than that, you should not be expecting any tax changes. Now, it is a negotiation. So either what could happen is all the Democrats get on board and they pass the law without the support of any Republicans. That could happen. They could compromise with the Republicans and come up with a new revised, maybe these get lowered, maybe they get modified, or nothing at all can happen. We saw how long it took last year for the stimulus packages to get passed. So they would be presented, they'd be negotiated, and it seemed like it would take forever before those bills ever got passed. The same thing could happen. So what do I advise you to do today? I'm not a financial planner. I can't provide advice even as a tax advisor. I can only provide advice to my specific clients. But what I will tell you is to talk to your financial advisors, because a couple of things to think about is maybe looking at repositioning, selling off high. If you have stocks with a high basis, selling that off, getting recognizing those capital gains now while the rates are still low. The other thing to look at and consider, instead of putting money into a traditional IRA, putting money into a Roth IRA, or putting money into or converting a traditional IRA to a Roth IRA. The reason is, previously the thought was you're going to have high taxes now and low taxes upon retirement. Right now, taxes are the lowest they've been and historically, and probably will be. You can count on them going up in the future. So depending on your retirement timeline, chances are you may actually pay more taxes, tax rate or effective tax rate in retirement. So it is something to consider. I know a lot of financial advisors are reaching out to their clients and walking them through, doing projections for them of the benefit of converting, paying tax now versus later, making non-deductible tax contributions to Roth IRAs now. So I just want to put that out there. Other couple things I want to mention. One is proposals in the new legislation. The proposals are definitely to fund the IRS more. We've heard for a long time that the IRS has not been funded. They can't keep up with audits and keeping up with staffing, keeping up with equipment. There's a lot of talk right now that many of the IRS offices don't have printers that are working. So getting them new equipment, and the printers not working, what I understand is that they haven't allowed the contractors that repair the printers to come into their office during the COVID time. So there's this crisis of not having printers that work. Anyway, the IRS is asking for more money, high probability that they will get more money. And I'm not telling you that to scare you, that you as an individual will be subject to an audit, just letting you know that audits will increase once they get this funding. It'll probably be corps. It'll probably be looking at corps that are doing offshore, or people that are trying to offshore or hide their money. That's probably where they'll go. But I just wanted to make you aware of that. And then the last thing I want to mention before I wrap up here, I'd be remiss not to do, the Consumer Price Index came out for April 2021 this morning. The Federal Reserve released it. It was 4.2% higher than April 2020. Now, a lot of people are panicking about that, so my recommendation is not to panic. You're looking at April 2020 being one of the worst months that we've had in a very long time. So this 4.2% increase was coming from a time where there weren't pressure on wages, energy costs were low, a lot of things were happening during the pandemic. So I wouldn't look at just one quarter. That said, there's a 0.8% increase from March to April 2021, and that's what you should take a closer look at. Now, again, I still wouldn't panic. It doesn't mean that inflation is going to be jumping to huge rates. It just means that we are definitely probably going into some inflationary times. And we'll see the Federal Reserve will keep an eye on it. They'll, determine whether interest rates increase. We've had historically low interest rates for quite some time. And so the expectations for that to increase. So you're again seeing changes and swings in the market because of the talks of inflation. So just keep that in mind, that some inflation is coming, but it's not going to be like jumping to 17% or 15% or some crazy number. So just putting that out there. So thanks, everybody. I wanted to just give you some updates on what I'm hearing on the proposals, the two legislative bills that are out there that Congress are discussing, so that you know and are aware of how that might impact you, how that might impact your small business. If you have any questions, please post them in the comments below or reach out to me. Here is my website. You can reach out to me there. I'm happy to help you do a discovery meeting. I like working with small businesses and their owners to take a look at their tax position, take a look at their financial statements, take a look at their profitability, and help them in any way I can with my 30 years of knowledge. So if you want to do a free discovery call, please go on my website and schedule a discovery meeting with me, and I'm happy to talk to you about that. So thanks for joining me today, and please come back. I'm usually here on Wednesdays at 5 p.m. Eastern. You can find me both on Facebook Live and on YouTube Live. My channel over there is Health and Taxes YouTube, and please join me there as well. So thanks again for joining me. And again, if you have questions, please reach out to me. Happy to address those. Have a great day.